the cloud. Hello, welcome back for Financially Fit. Alan Dembski with Tanya Baya, both of Buffalo First Wealth Management. On this sunny day in Buffalo, New York, 50 degrees out. Can't ask for a better late winter, early spring day. Isn't that true?
That is absolutely true.
So it's going to be 60 tomorrow and 40 on the weekend. Only in Buffalo does that happen. But we want to welcome you back, and we have an exciting topic, I think, for today is health savings accounts. They've been around for a while, but a lot of people aren't sure what they are or what they can do. And I'm going to tell a quick story at the end. Hopefully people find it fascinating and do the same thing, because my wife didn't even know that we could do that with the HSA at the end. So I'll save the best for last. But without further ado, we'd like to kick it off today, and I'm going to turn it over to Tanya to talk about what an HSA is.
Hi, everybody. I'm very excited about HSAs too, because I feel like I've just kind of gotten to know them better than I had before, probably because I now have a high deductible health savings plan. So if you have a high deductible health savings plan, say that 3 times, what happens, of course, is that you have to put a lot of money out before the insurance really kicks in and helps you out. So health savings plans, they allow you to maximize by putting money in that's tax free. And actually it's called it's really cool because it's called a triple tax. It's triple tax advantage. And what it is you put money in before taxes. And then of course, as long as it's a medical, as long as you can use it for a medical occurrence, it can come out and you can pay for it without paying taxes, and it can grow within the HSA tax free. So it's one of the best products out there. But in order to have it, you have to have the high deductible, which means you pay at least $1,400 out of your own pocket before the insurance even starts to kick in. All right. So there's a cap at the end of $7,000 before the insurance really takes over. So if you have a high deductible, you have the ability to put up to, if you're a single person, $3,600 into an account, or if you are a family, you can put $7,200 in
into the savings plan,
into the health savings account.
Okay.
Which then allows that money to grow in a manner that is tax free. So that's the advantage. And what they're trying to do is help you out, because you are, up front, you are going to have to pay. But if you aren't, if you're really not using it all, and if you really don't, you can, with that money, you can grow that money year over year. And that can really help later on when you might have more medical expenses. When we retire and we get older, we tend to have more medical expenses, and this can help with either healthcare for now or healthcare for later. Alan?
So it doesn't expire when I hit 65 or for Medicare?
It does not. It does not.
Nice.
So it is. And it's it's even, if you really think about it, it's even better than an IRA, because with an IRA, it's tax deferred, right? You don't have to pay taxes going in, but you are going to have to pay taxes coming out. This one, if you use it for a legitimate medical expense, you never have to pay any taxes on the money that you have made. And
so it's pretty nice. It's tax deductible.
Yes.
Tax-free growth.
Yep.
Tax-free withdrawal.
I mean, how cool is that?
You definitely can't beat that.
No.
But you did talk about one of the bigger things is who's eligible. And as we've seen it, especially if people are watching this countrywide in the US, high deductible plans have been around for a very long time. However, they have been slow to adapt through the North, in your union-rich states, if you will, where people have been pretty much accustomed to HMOs and PPOs, where they just go to the doctor and they pay their 25 or 50 bucks and get their services taken care of, and then they walk home and that's all they had to pay. But the high deductible plan with let's just use a family of $2,800 out of pocket expense if I go to the doctor. So what you're saying is if I go to the emergency room and my bill is $700, I have to pay for that.
Yes, exactly.
So I have to pay $700. The insurance company doesn't pay anything, but I pay my premium.
That's correct. And you pay your premium.
Oh
That is
man.
correct. Yes.
So for some people, for people that aren't very healthy, a high deductible plan could be really expensive, more so than an HMO traditional plan where you're going to pay more, but they're covering more right from the
Right.
upfront. So I think that's where people kind of get confused with the high deductible plan, is not understanding, or annualizing what their medical costs have been. Now, of course,
Right.
we can't see the future, and those catastrophic injuries or illness, or God forbid, COVID, and we're in the hospital. But where we don't understand where we understand what our costs are, say if my kids go to the doctors once a year, my wife and I go to the doctors once a year, what's an office visit? Let's say $100. So it's $400. The difference between an HMO plan and a high deductible plan is probably $800 to $900 difference.
Right.
Where I could fund this HSA, get a deduction for my contributions to an HSA. Say a HMO plan is 10,000 family and high deductible is 5,000. I could still put in 2,500, just let's say half, 2,500 into an HSA.
Right.
That almost covers that $2,800 next year if I have to go for extra medical expenses, right?
Yes.
So the other kick side, and I think did you mention the family was what, 14,000 maximum out of pocket?
I said 7,000 for an individual. I didn't. So it was 14,000
Oh, okay.
for, yeah. So that's a good catch.
A lot of the times it just doubles anyways for families.
Right. Exactly. But yeah.
So let's just say, again, the same example of the 14,000. So now I hit my deductible of 2,800. Then generally I have that co-insurance where the insurance company will still pay some of it, and then I have to pay some. Usually it's like a 20/80. Insurance company pays 20. The insured pays 80%. So to the maximum of 14,000 out of pocket, which is still a lot of money. However, if your medical bill is 30, 40,000, I guess 14,000 isn't that bad. But you still have years, like you were saying, of compounding in my HSA or building every year. If I put in 2,500, it's just going to keep growing. What are some of the options that I could do with an HSA? Is it just a bank account?
See, that's the really cool thing is many of them are bank accounts, but now what they're starting to be used for is investment products. So you can invest in it. You need to, I think, keep about $2,000 in it. But anything over about that, you can look to. Like with us, we work with Charles Schwab. There is an option where you put that money in and it can grow for you over time rather than just sitting in a savings account. They have plenty of options of what to invest in.
Yeah, it's probably a good idea too, to have at least, so say if your minimum deductible is 2,800, probably have that in cash available to use right away, rather than worrying about if I'm investing, as we've seen over the last couple of weeks, the market trending downward, where we don't want our HSA money to trend downward if we might need it. But annualizing out your cost and then seeing what your deductible is, at least have 1 year of deductible in cash. So where it's not affected by the market.
Right.
And again, you got to kind of play to what your health is. It's very health driven. What's my family situation? What's my personal situation? Do I just do my regular physical once a year, which is 100% covered underneath high deductible plans? So I guess, and that's where financial planning comes in too, is when we do financial planning, the conversation is medical. Okay, you're working for XYZ company. I want to retire. What am I going to do for health insurance?
Absolutely. Well, and you can do it, like you said, for retirement, or if you're looking at something, let's say you do have somebody in your family, or if you're like me and have 3 kids, and it's not such a problem now that they're older, but when they were younger, we were constantly going to the doctor, whether it was a broken leg, stitches for something else that happened. It seemed to be a yearly basis. You can put your money in, and like you said, for not the investing part, if it's that period of time in your life where you really need more of it, you still can put it in, get the tax benefit, pull it out and pay for the stuff. Versus as you get, if you get to a point where now my kids are older, they don't seem to be, they aren't getting their sicknesses as usual. They don't have the ear infections. They aren't breaking their legs. There were a few, just a couple, but anyway, different parts of their body.
Boys will be boys.
Yeah, that's right. Oh, my daughter wasn't any better though.
Oh, okay.
But you're right, the boys were definitely boys. But now I'm looking at the fact that, I'm not having to pay as much out of pocket for the healthcare. And by putting it into the HSA, I can look towards, maybe adding it up and investing it more for when maybe I myself start to need it. After all, we were talking about insurance earlier today, and we women, we tend to live longer and get sicker because of it, which kind of sucks. But but it's something to look at, that long term, I definitely would like to have that bucket. That's just another bucket of where I put my money and where my investments are and what my assets are.
Right. And, I seen on Fidelity's website, the average person will spend 280,000 in medical
Crazy.
by the time they retire and pass away.
Mm-hmm.
And that does not include long-term care too. So could you imagine if they added long-term care, another, let's say 300,000, so $500,000 in just medical costs in retirement?
Right.
I guess that's why insurance companies now give you credits if you're healthy, because they know what it's going to end up costing them in the future.
Absolutely. That's so accurate. I mean, now with people who are older, insurance companies are providing mental health for them, with free of charge, because it just makes them, with COVID and with other things, there are aspects that weren't around as much, and they're finding out, though, if you can do that up front, right, then the health it's less expensive for the insurance company if they can help their clients and up front.
Yeah, that's an interesting topic. I guess we'll cover that a different day. But how is
Right.
insurance companies going to, pre-existing conditions? I know they have to cover them now if things ever change with our healthcare system. But what do they call it? With COVID, the lingering COVID effects. I forgot what they technically term that. I forget it off the top of my head.
I can't remember either. No.
But the long-term effects of COVID, how that's going to affect our medical system going forward. But that's a different story for a different day. Right. But if you have the money set aside, it will help cover those expenses. Exactly. And there is I wanted to touch on before we depart here today is the FSA. The FSA is traditionally, it's flexible spending account, which is generally done through your employer, through your cafeteria 125 plan usually. But that was a use it or lose it. But now they let you carry over $500 per year on that. Mm-hmm. So that was, you want to talk about, figuring out what your medical costs are to contribute to your HSA. Yeah. And FSA, you have to be almost right on the penny, else you're going to lose it. So this gives you, oh, go ahead.
Oh, I was going to say, a number of years ago, we had an FSA, and that is exactly, we would end up with $300 and on December 26th, and we were out buying whatever, Advil. It's like when Tylenol, when they allowed it, then they stopped allowing that. But right. When they were allowing it, maybe because of the 500, but when they were allowing it, we were literally out spending, money that we didn't even need, just simply because otherwise we were going to lose it. So,
right.
Yeah. I think I still have Band-Aids from 8 years ago. So because they were just stockpiled.
You never know when you're going to need those, right?
Right. See, most useful.
Very good. So that was our little chat, and it is tax time, and we thought it was a good timely subject, the HSA talk. And we were just saying, or I said to Tanya, I said, maybe I'll take some of my stimulus money and put it in my HSA. Oh, you know what I did forget though? My story about the HSA. Yes,
that's right.
So I had somebody say to me one time, or I said to somebody, yeah, my child's braces are tax deductible. And they looked at me like, you can't deduct braces. Dental insurance doesn't cover braces usually for most part, or they cover a small part. But they said, how in the heck did you deduct your daughter's braces? I said, what I did is I just funded my HSA, and then paid the orthodontist from my HSA. So now I get a tax deduction for funding my HSA, and then I pay my dentist or orthodontist for the monthly premium for the braces. So it was a tax deduction in my books, right? Deduct and pay. So it worked out, and there's no time limit on when you have to put it in and when you can take it out. So there's my little FYI for you. So if any of your kids need braces, certainly fund an HSA if you're eligible, and pay right from your HSA to help you out on those federal income taxes. So with that, that was our tax tip for today as we're rounding the corner to the end of tax season. So thank you very much, and we'll come back at you next week. As for me, Alan Dembski with Buffalo First and Tanya Baya, have a great day.
Bye, guys.